With us now is DoubleLine Capital Deputy CIO Jeffrey Sherman. Jeffrey, that's pretty much what the market is telling you, although it's close to a 50-50 shot of whether they even raise rates this week.
Yeah, no.
Why do you think it happens?
No, that's the case. I mean, look, the Fed has gotten himself in a pickle here, right? I mean, there's the laxity oversight of the regulator. I think we can all say that's what caused some of this in hindsight. But also, they have to stay committed to this inflation-fighting campaign, and so they don't want to lose face, because if they step back and they don't hike, ultimately they're just succumbing to the whims of the market and saying that this was their fault too to begin with. And so I think that they want to stay committed here. They want to show that they are inflation fighters, but ultimately it's the market that's letting them hike, Sarah. And I think that's the important thing to say here. If the market did not at least have a 50% chance of a hike priced in, I don't think the Fed goes on Wednesday. And, just because we're focused on Credit Suisse and the things that have happened over the weekend, there's still weakness out here, as you guys were just talking about. Look at First Republic. And so the challenge that we have right here is a regional banking problem right now and a lack of confidence there. And so really, even though the market's priced them, my stance, as I've told you, is that the Fed should stop hiking at this point, at least take a pause and assess the landscape, because the systemic banking is more important than trying to fight inflation in the near term.
Right. Although you could argue the opposite. But so what are you guys doing? Are you buyers of treasuries right here, right now, after such a tremendous move already in the last week?
No, we're not incremental buyers. As I've been talking to you about for the last few months, Sarah, is that we've been incrementally adding to our treasury position, positioning for kind of bad things to happen. And I think I was on the show a couple of weeks ago here, and I think you were off that day. But ultimately, I was saying that you buy insurance before the storm comes. And here we are in the middle of the storm, and it seems a little bit late to be restructuring the portfolio to try to add to the treasury position today. And so we've been carrying a very relatively balanced approach. But as I look at this materialization of what's going on in the banking system, to me, this just argues for the cost of capital going up. And if the cost of capital is going up and the cost of lending is going up, that's going to lead to tighter conditions. And so that's where I say that at this stage, we could argue that the Fed should pause, because ultimately, we know this is going to lead to more of a slower economy. This actually does the Fed's job for them through that contraction. And so I think it's a little late to be adding to the treasury position. We're very comfortable where we are today. And again, I think right now, there's nothing wrong with owning a little bit of risk in your portfolio. But ultimately, the risk you should be avoiding is that extremely speculative risk, such as the lower credit tiers.
So speaking of, Jeffrey, it's Dom here. Those lower credit tiers, they're coming into the forefront here because of these contingent convertible bonds, these additional tier 1 bonds that we're seeing in Europe. We don't have them here in America, but we have things that kind of act like they do out in the risk spectrum right now. Are there dislocations that have been created in certain other parts of the credit market or even the preferred equity market that have now presented themselves as opportunities because of what happened with rates and where the toss-up is right now with whether the Fed should do even more?
Yeah, I think the COCOs, or the contingent convertibles you talk about, too, are something that we've never really touched at DoubleLine. And so with today's news, or yesterday's news, I should say, we're very thankful that we've always avoided that, as we can never really get comfortable with the risk of those securities. But you talk about opportunities. And so, Dom, I think it's too early to be hunting for those opportunities right now. We've only seen the tip of the iceberg of some of this stuff out there. And so ultimately, as I said, if it leads to wider spreads, it leads to a higher cost of capital, that means there's even more stress on those companies. And so although one should be circling the wagons and thinking about it, I think this is not over yet, and we need to be very careful in terms of looking at some of those distressed opportunities. And so if the thesis plays out that the cost of capital is going up, you'll have plenty of time to buy some of these opportunities as we get more clarity on what actually happens within the banking system.